Okay, Chapter 15, the cost of home ownership. Values that's at the end of this chapter in the summary practice test may vary somewhat from one version to another version of the textbook, and definitely will vary in your Connect activities because each of the problems are based upon algorithms. The concept of each one of the problems, however, will remain the same. So let's go ahead and take a look at the problems, the drill problems at the end of Chapter 15. Okay, we have a home that costs $140,000 and we're going to make a $10,000 down payment. That's really not enough of a down payment in these days, so that would not be an accurate down payment. We would need, let's see, 20% down payment based upon the legal standards of today's 2019, and 20% of that would be $28,000. So this particular account is going to have to be charged PMI, which is kind of a mortgage insurance type of program to ensure that if something happens to you, that you will definitely be able to pay off your loan. So that's something that's required for you to have a 20% loan where you don't have to actually have a PMI that's built into this. But nonetheless, we'll just work the problems here. We're going to subtract out our down payment to give us the principal or the amount financed to the loan of $130,000. We're going to divide it by $1,000 because our amortization table is based upon $1,000. So that'll give us $130,000. And we're going to take that times the corresponding factor of 3.5% and 25 years based upon the table. So I'm going to go to the table at 3.5% and 25 years. Oh, goody. 3.5% doesn't look like it exists here, but if I had it right here, 3.5%. I'd probably have to use my, in 25 years, we're going to find the corresponding factor of 3.5% in 25 years, whatever that would be. And we would take that times our result. It's actually 5.01 if I had the correct table that was listed right there. 5.01 times 130. Okay, there's a calculation right there. And that will give us a monthly mortgage payment of $651.30. Okay, number 2. $90,000 minus the down payment gives us $85,000. To use a table, we will divide 85,000 by 1,000 to give us 85, and then find the corresponding factor on the amortization chart of 5.5% in 30 years. Let's see if that one works. 5.5% in 30 years. Okay, there's 5.5%, and there's 30 years. The corresponding factor is 5.68. Okay, let's go back to the problem. Okay, yes, 5.68. And we're going to take that times 85, and that's going to give us a monthly payment of $482.80. Okay, number 3, $190,000 less $50,000 down payment. So the amount of financing of this loan, the principal is $140,000. Divide by 1,000 for the table. We'll give you $140,000. And then find the corresponding factor of 7% and 35. $7 and 35 is going to be 6.39. Going to multiply 6.39 times 140, and that will give us our monthly payment of $894.60. Now, the $894.60 does include the principal and the interest. and then any type of property tax, PMI, insurance, all of those charges will be attached on top of that, and an escrow account will be created for you. And so your monthly payment will technically not be $894.60, but it'll add those other taxes and insurance to that as well. Excuse me. Number 4, what is the total cost of interest in problem 5.2? So our monthly payment is $482.80, and there's 12 months in a year, and it's a 30-year loan. So 30 times 12 gives us 360 payments. So $482.80 times 360 payments is going to equal $173,308. Subtract the amount financed or the mortgage amount of $85,000 and the amount of interest that we paid, $88,808. Let that sink in. In 30 years, you're going to pay $88,808 more money for that house because you did not have the amount of money that you needed to pay for it in the first place. Find something that's affordable. Make sure that you can put as much of a down payment to the house as possible. Every single month, make an extra payment that goes specifically to the principal to reduce the number of years that you have to pay on that particular loan. $88,808 will go a long way, right? Number 5, look at what 1.5% interest increase will do to you. If the interest rate rises to 7% in problem 15.2, what is the total cost of interest? So the table factor of 7% in 30 years. Okay, let's look at the amortization chart. 7% in 30 years, that's 6.66. That's a corresponding factor on that one. 6.66. Okay, multiply that times 85,000 divided by 1,000 will give us 85, so 6.66 times 85 gives us a monthly payment of $566.10. That's a 30-year mortgage, so we're going to take that times 12 months in a year to give us 360 payments. That's going to give us a total of all of our monthly payments of $203,796. We'll subtract out the amount of the mortgage of $85,000, so the interest is $118,796. The difference from 5.5% to 7% is $29,988. It's just 1.5% difference, and you make nearly a $30,000 extra payment. Can you believe that? That is amazing. Every month, make an extra payment to reduce the amount of years that you have to pay, and you'll help build your wealth much more quickly by doing so. Okay, number 6. $150,000 house less $30,000 will give us an amount mortgage or amount financed of $120,000 less 1,000 or divided by 1,000 for the chart, and that will give us $120,000. We're going to find the corresponding factor of 7% in 30 years, which we just used in the previous problem, so it's 6.66. Take 6.66 times 120, and that will give you $799.20. Okay, now let's use a simple interest formula to calculate the amount of interest. And that's this part right here. The interest problem is, remember this one? Interest is equal to principal times the rate times the time, IPERT. Okay, so the principal is $120,000 times rate of 7% or 0.07 times the time of 1 divided by 12. That will equal interest of $700. Subtract that $700 from the monthly payment of $799.20, which includes both your principal and interest. So then if you subtract your interest out, your principal will equal $99.20. So the balance at the end of the first month, after you subtract the principal, the amount that you have in your owner's equity of this particular home is $99.20, maybe one or two doorknobs. Subtract that principal of owner's equity that you have in this home for the end of first month of $99.20. Subtract that from the amount of your mortgage of $120,000. The balance at the end of the month is $119,900.80. Okay, number 7. Subtract your down payment of $45,000 from the cost of your home of $225,000. That will give you the amount of the mortgage of $180,000. Divide that by 1,000 for the chart, which equals 180. And then you're going to find your corresponding factor of 5% and 15 years, which is going to be 7.91. Take 7.91 times 180, and that will give you your monthly payment of $1,423.80. Then set up your simple interest formula to find out the amount of interest for first month. So the principal is $180,000 times the rate of 5% times the time of 1 over 12 will give me interest of $750. Subtract that from the monthly payment, which includes both your principal and your interest, and that will equal your principal of $673.80. Subtract your principal of $673.80 from the beginning balance, and that will give you the ending balance of $179,326.20. Okay, I like number 8 because it has us complete an amortization chart for 3 months out of a total of 360 months. Okay, so Bob Jones bought a new log cabin for $70,000 at 11% interest for 30 years. Prepare an amortization chart for the schedule for the first 3 periods of that 360 payment period time of 30 years. Okay, first of all, I'm going to calculate my monthly payment. So I'm going to divide 70,000 70,000 divided by 1,000. It's going to equal 70. And then I'm going to find the corresponding factor of 11% and 30 years. 11% and 30 years is right there. And 30 years goes straight across equals 9.53. 9.53. Okay, I'm going to take 9.53 times 70 to equal the monthly payment of $667.10. Okay, so we're going to keep that in mind and we're just going to kind of push that off to the side a little bit. Now we're going to use our simple interest formula. Interest is equal to the principal times the rate times the time. 70,000 times 0.11 after you move the decimal point 2 places to the left times 1 month divided by 12 months equals the interest of $641.67. I'm going to subtract the $641.67 from the monthly payment of $667.10, and that was going to give me a principal of $25.43. Now I'm going to subtract the principal of $25.43 from the beginning balance of $70,000, and my balance of the loan outstanding is now $69,974.57. Okay, now I'm going to bring that balance forward to my next month, and we're going to use that as a principal times the rate times the time, and we're going to repeat this process. So $69,974.57 times 0.11 times 1 divided by 12 gives me interest again of $641.43. Subtract my interest from my monthly payment of $667.10, and that will give me principal of $25.67. Subtract $25.67 from the beginning balance of $69,974.57, and that will give me my ending balance of $69,948.90. Now bring that forward, $69,948.90 times 11% times 1 divided by 12 equals interest of $641.20. Subtract your interest from your monthly payment, which includes principal plus your interest. So the difference will be your principal of $25.90. Subtract that from $69,948.90, and that will give you the ending balance of the third month of $69,923. What I hope you see from this is that you start out with the largest amount of interest in your first months of your loan. This is a 30-year mortgage, so it is 360 payments. So you start out with the most interest initially of $641.67 for the first month, and then it reduces slightly for the second month of $641.43, and reduces a little bit more to $641.20. So far in the first 3 months, you have about $1,900 to $2,000 of interest that you've already paid on this brand new home. Now look over here to the principal. The principal, the first month, we have $25.43 in equity. Then the next month we add just a little bit more, $25.67, and then the next month we add a little bit more to $25.90. So now we have about $76, $77, something like that, in homeowner's equity, the amount that we own of the home. Almost $70, somewhere in there. $75, $80, somewhere in there, and we paid $2,000 in interest, somewhere in there. So as you can tell, you pay a lot more to interest. Make an extra payment to your principal so that you can pay off your house much more quickly and not spend near as much money in interest as it reflects that you would in this particular case. Okay, let's go ahead and take a look at the end of chapter summary practice test. Okay, the first one, Pat Lavoie bought a home for $180,000 with a down payment of $10,000. So her amount financed is $180 minus 10 is equal to $170,000. That's the amount of your mortgage or amount financed. We're going to divide that by 1,000 because our amortization chart's based upon 1,000. That'll give us 170. We're going to take that times the factor of 6% and 30 years. So 6% and 30 years is about 6, if I can read, 6.00 if I'm reading that correctly. And apparently I was. So $6 times 170 will give us a monthly payment of $1,020. Okay, now I'm going to do the simple interest formula. The second part is to break down the first payment break it down into interest and in principal. So interest is equal to principal times the rate times the time. So $170,000 times 6% or 0.06 after you move the decimal point 2 places to the left times 1 month divided by 12 months equals interest of $850. Subtract your interest from your monthly payment, and that will be the principal of $170. Okay, so that's equal to your principal right there. Okay, then the balance of the mortgage at the end of the month is we're going to subtract the $170 principal from the beginning balance of $170, gives us the ending balance at the end of the first month of $169,830. Okay, number 2. Jen Logan bought a home in Iowa for $110,000. She put down 20% and obtained a mortgage for 30 years at 5.5%. What are Jen's monthly payment and total interest cost of the loan? So I'm going to calculate 20% of $110,000, which is 10% is 11,000, and double that to make it 22,000. So we have a $22,000 down payment that we're making. Okay, that's down payment, and we're going to subtract that from the cost of the house of 110. That means that the amount of our mortgage, or the amount financed, is 88,000. I'm going to divide 88,000 by 1,000 to equal 88, and then multiply that times the corresponding factor of 30 years at 5.5%, which happens to be 5.68. So that's going to give me the monthly payment of $499.84. Okay, now the next thing it wants me to do is to calculate the total interest cost of the entire loan. Well, it's a 30-year mortgage, which is 12 months in a year, so that's 360 payments, times the monthly payment of $499.84, and that will equal a total of all your monthly payments of $179,942.40. It's a total of all your monthly payments, which includes your principal and your interest. And if we subtract our amount financed of $88,000, that's going to give us the total amount of interest that we're paying on this home of $91,942.40. Nearly $100,000 of interest in this $88,000 home. Can you believe that? Amazing. Make those extra payments. Never pay the minimum balance. Never, ever, ever. Make a much larger down payment if it's possible for you to do so. If you're in an apartment complex and you're paying $700, $800, maybe even $1,000 a month, start making the same payment to yourself. If you could double that, put that in a bank and allow it to grow a little interest, and then make a much larger down payment if it's possible for that to happen. Number 3, Christina Sanders is concerned about the financing of a home. She saw an email, Cape Cod style homes. I'm sorry, I didn't say email. She saw a small Cape Cod style house that sells for $90,000, and she's going to put 10% down. What is her monthly payment? And it's she's going to make this monthly payment for 30 years at 5% interest. And also, she wants to consider what she's going to do if she makes it for 30 years at 5.5% interest and 30 years at 6% interest and 30 years at 6.5% interest. What is the total cost of interest over the cost of loan for each assumption? Okay, so first of all, 10% of 90,000 is 9,000, so we're going to subtract that from 90,000 to give us the amount financed of $81,000. That's the amount of the mortgage. Divide that by 1,000 for the table, and that's going to equal 81. Okay, now the first thing I want to do is find the corresponding factor of 30 years and 5% on that chart. And that's going to be 5.37 times 81. And now this is your monthly payment of $434.97. If I make that a payment for 360 months, the total of all my monthly payments is $156,589.20. Subtract the amount financed of $81,000, and the amount of interest is $75,589.20. Okay, now to find the corresponding factor in the second assumption of 30 years and 5.5%, the table factor is 5.68 times 81, which gives us a new monthly payment of $460.08, which is just about $30 more than what it was at per month for 360 months. So 460.08 times 360 months gives us a total of all of our monthly payments of $165,628.80. Subtract out the amount financed of $81,000, and that will give you the interest of $84,628.80. So just going from 5 to 5.5%, we go nearly $10,000 more in interest over that 30-year loan. Now, 81 times the factor of the third assumption, 30 years and 6%, is 6. So the monthly payment is $486 times 360 months gives us $174,960, less the amount financed of $81,000 to give us interest of $93,960. Okay, then the fourth assumption of 30 years and 6.5% will give us a factor of 6.33 times 81 gives us a monthly payment of $512.73. That principal and interest times 360 months gives us a total of all of our monthly payments of $184,582.80. We'll subtract $81,000 from that for the amount financed, and that will give us interest of $103,582.80. So to go from 5% to 6.5%, 1.5% more, the difference between $75,000 and $103,000 is over $25,000 difference. Just 1.5% over that 30-year period. If you can also do this, and if it's beneficial for you to do it, decrease or pay off, make extra point payments to reduce the number of points if that's possible for you to do with your financial institution. Loretta Schulten in number 4 bought a home for $210,000 with a down payment of $30,000. Her rate of interest is 6% for 35 years. Calculate Loretta's payment per 1,000 and her monthly mortgage payment. So subtracting 30,000 from 210 means the amount financed is 180,000. Divided by the table chart of $1,000 gives us 180 times the table factor of 6% and 35 years of 5.71. That gives us a monthly payment of $1,027.80. Now, number 5, using problem number 4, calculate the total cost of interest for Loretta Schulten. So our monthly payment of $1,027.80 times 35 years times 12 months gives us 420 payments. That equals a total of all of our monthly payments, which includes our principal and our interest, of $431,676. Subtract that from that the amount financed of $180,000, and that means the total cost of interest for Loretta over that 35-year period is $251,000, $251,676. Wow. And the cost of her home was it was financed at $180,000, and she's going to pay $250,000 plus for interest. Let that sink in. This concludes Chapter 15, The Cost of Home Ownership.